Yeah, man, it's your boy TBT, back with another video. Now, what we're gonna do is we're about to go over how ICT uses the Fibonacci to establish premiums and discounts. All right, so let's talk about it. First of all, premiums and discounts. You know what a premium is when there's a higher price for something, right? And everyone wants to pay that premium to get that specific service or goods or sales, right? And what a discount is. A discount is when there is a lower price that's established within a certain good that someone is selling, and that discount allows you to get in at a lower price to buy, right? So when the housing market goes down, people will be able to buy houses that were $500,000 for maybe $300,000 because there's a discount, right? So right now, the housing market is at a premium because it's at an all-time high. People are having to go up to $500K just to buy regular, everyday houses, right? So that would be an example of a premium, right? So when we talk about premiums and discounts within the Forex market, what ICT likes to refer to is when price has, within a certain bias, within a certain higher time frame bias or trend, when price has essentially reached back above 50% of a certain range. So let's just say, for instance, this range here. Let's zoom in here. If we use this range here and we're looking at using the Fibonacci retracement tool, right? Let's say that this hasn't happened yet. We go with the fib. When you're in a bearish trend, you always go from the most recent high to the most recent low. Never this way, right? It's always left to right, right? And it's the same way with a bullish trend, except you're going right to left, right? But with the bearish trend, you're always going high to low, left to right, okay? With the Fibonacci retracement tool. So most recent high to most recent low, and then you measure out the retracement, right? So with ICT's Fibonacci settings, what he likes to set them at is you have the 1, which is just 1. You have 79%, 70.5%, 62%, and 50%. The 50% is where we get past the premium and discount areas, right? So when price trade in a downtrend, let's start here. In a downtrend, when price trades above 50%, that becomes a premium. When we're in a downtrend, we are looking for premiums to tell us when to get into the market on sales. Is that clear? We can rewind if we need to, you feel me? But when you're in a downtrend, you're measuring the Fibonacci tool from left to right, most recent high to most recent low, in a dealing range, right? The most recent high to the most recent low. And then you're measuring the retracement, that when price trades back up into this range, you're using this 50% as your telltale sign that price is going to be, whether or not it's going to be in a premium or a discount. In a downtrend, we want to take sales once price has entered into a premium in a downtrending market, right? So you see what I'm explaining here. Now, excuse me for the switch of clothes. I had to redo the video because half the video didn't even record. So it is what it is. But anyways, we here. So in a downtrend, you can use ICT's concept of a premium versus a discount. When you're in a downtrend, when we trade back above that 50% range, look, we've traded back above it. Now, that doesn't mean just take any old trade above the 50% trend, the 50% mark, right, of this dealing range, of this range. It means once we trade back up into what we want to see, the order block, the fair value gap, if you have a breaker, it trades past the breaker, all the things that I like to explain that I use from ICT's public model on YouTube, that is when we start to get involved, right? So you see this run on liquidity, kind of a run on liquidity, because here's some sell side liquidity or buy side liquidity. Here's some buy side liquidity that it ran up, didn't get so past it, but then all of a sudden got back up past it, got back up to a zone that we were at, that we were kind of trading out of before, right? And so now we're looking to zoom into this area. As we see it turning around, can we find what we like to see in terms of a price range, right? When we see we've been overall bearish, right? But now we're looking to see if we can find above that 50% mark. Can we find our order block? Can we find our fair value gap? Can we find price trading back up into it? So we're on the 5 minute here. It's kind of iffy. I mean, you have an order block here, 3 up close candles, but there's not really a fair value gap per se around here that price trades out of. Same here, order block, but trades out of it kind of. There goes the fair value gap, I guess you could say. But it's like you don't really see exactly what you want. Plus, this time frame here is kind of in the right time frame that you would want to look for trades. But you would have to see what's going on with news, and you have to see what's going on with some of your other keys to figure out if that's what you want. But even just here, I don't see exactly what I want to see. I would like to see this fair value gap across from this order block, and then price trading back up into that area for me to get a nice trade. Now you see as price continues down, it trades back up into fair value gaps as it goes down. Maybe we can see what it looks like on the 15 on a slightly higher time frame. But what we do see here is that price, after having traded up and kind of giving us that establishment that it wants to trade back into the higher time frame bias direction, it reaches back up into that range, doesn't pass this fair value gap, this sell side fair value gap. This stays open, right? So now you may be asking me, so this stayed open, why wouldn't I assume that price is going to continue up? Because we're in an overall bearish market, right? The DXY, the US dollar index, has been going up exponentially over the past half a year, right? So we're not worried about taking buys, essentially. We're really waiting for this to fizzle out, this buy side movement, so that we can then get into a sell side option or trade, type of trade. I say option, I just mean opportunity, like sell side trade opportunity, right? So now we're looking here, you're still not really seeing what you want to see. So for me, it's like, unless you really know that, you know, on a large downside move like this, if you really are confident in taking this trade, you know that there's a zone here and if price trades past it, and if it doesn't trade back into it, then you can take that trade. That's up to you, right? Like, we don't really see the model that I like to not teach. I'm not teaching anything, but I like to, I guess you could say, regurgitate from ICT's mouth. We don't really see that all the way until here, right? So now here, within, this would be the London kill zone, 3 a.m. to 5 a.m., or you could say 2 a.m. to 5 a.m. Order block, fair value gap, price trades up into the fair value gap, and you see immediate displacement away from this zone. That's the type of trade that I would take. 3 a.m. in the morning, you kind of already have seen, you know, you're safe. You're having seen price already go up, you know, against the higher time frame bias. It break back down, has zones that are open, fair value gaps that are open, doesn't even trade into them, begins to move viciously towards the downside, which then gives you the key that during that time frame that you really are looking into, that 2 to 5 a.m. if you're in the London session, or that 8:30 to 11 a.m., 12 p.m., those are your kill zones for those sessions. Now you're within a kill zone and within the time frame and within the model, looking at exactly what we talk about. We talk about order block, two up close candles, fair value gap, price trades with impulse past the fair value gap, past the order block, forming a fair value gap. Then price then reaches back up into the fair value gap, does not breach the order block range, does not breach the fair value gap range, and then trades away. That is a trade that we would take. Now, a lot of folks would tell you, oh, I'd be up here at the top. I'd be in up here at the top. Look, man, I ain't gonna lie to y'all. This is a little scary for me, okay? ICT, he takes these types of trades. He knows what he's doing up here. You know what I'm saying? I don't, okay? He might have been able to get in even here. Me, I'm taking the safest trade I can, the one that I can be confident that if I lose it, at least I knew I was in on the right trade, okay? So let's go back to the using the Fibonacci and the premium versus discount, right? So this was an example of a discount. Let's go back over, the premium, sorry. Let's go back over it. This range, we're looking at this range, price trades up past the 50% mark. Now we're in a premium. When we're above that premium, that's when we're really looking to take trades in the sell side. Now, once you get that type of impulse, and then just basically right below that level, if we extend this level out, just basically right below that level is where I was identifying to you that I saw the model that we like to trade, right? So this is the 50%. This is where we'd be getting in perfect. We're right at 50%. We're right at essentially the premium mark. And then you're taking that trade at the beginning of the London session for the most part, and you can get the majority of that move, and you see the move went over 100 pips easily. Just from this one entry. Then you see you got more entries down here. So from this one entry, if we were to enter up here somewhere, you got 100 pips right there before 8 a.m. That's beautiful. And that's on Friday, I think. Is that a Friday? I'm not sure what day that is, but it was beautiful. I didn't take it because I wasn't even trying to take that trade. But you see, as we continue down, what do you see again? Order block, fair value. Now this is not really a fair value yet, but at least you have the order block it trades back into, right? Order block, fair value gap, price trades into it, and it trades up a little bit, but it still doesn't breach the order block. You have another entry. There's multiple entries on this trend here to get in, right? As long as you're not breaching the fair value gap zones and you're not breaching those those order blocks, you're good and safe to trade.